Welcome, everybody. My name is Vernon Bond, and this is the second session to the Introduction to Real Estate. Now, before we get started, I want to share with you all a few things about who I am and how I got into real estate. Now, one day in 2014, I was sitting at home playing on my phone, and I remembered that my brother in law said that I should look into real estate. So I downloaded the Zillow app, and yes, Zillow existed back then. But I downloaded the Zillow app and I started playing around with the real estate on the app. I started looking at different real estate, what houses were sale for, and I noticed that there was a house for sale in a neighborhood not too far from where I live. And that house was for sale for $250,000. Now, I looked at the next house for sale, which was on the same street, and I noticed that house was listed for $150,000. So I was a little confused. So I went into the profile on each listing, and I noticed the house that was listed for $250,000. It was nice. It had new kitchens. It had new bathrooms, fresh paint. I mean, it was HGTV ready. And you're gonna notice that I say HGTV ready a lot in my class. Now, the other property, I looked at those photos, and those photos were old. The house was old. The house was in pretty bad shape. And I looked at the size of the house, and they both were the same size. They both had the same amount of bedrooms, same amount of bathrooms. The only difference is one house looked good and the other one didn't. And when I realized that there was $100,000 price difference on the houses, I mean, I saw nothing but opportunity because I realized you can buy a house for $150,000, put $30,000 into it, and then sell it for $250,000. I mean, I knew from there real estate is what I needed to get into. So what I did was I moved back home to my parents' house. I spent a year saving money. I got my credit in good shape, and I went out and bought my first house. So I bought a townhouse back in 2015. It was a 4-bed, 3.5-bath townhouse, 3 levels. Now, when I moved into that house, honestly, I was lonely. I ain't gonna lie. I was single, didn't have any children. It was just me in this big old townhouse. And I had spent most of my adult life living in apartments or living in dorms. So I wasn't used to all this space. So what I did was I called up some of my close friends, some of my fraternity brothers, and said, "Hey, you guys want to move in with me? I have three extra bedrooms. You guys can pay me, $500 a month each bedroom, and you guys can live in a townhouse." And it worked out. 2 of my friends moved in. They paid me $500 each, which was $1,000, and I collected $1,000 on my house every month. And I did that for 7 years. And that's when I realized that real estate can be used as a vehicle to generate income. And I actually house hacked my house before I even knew what house hacking was. So that was my very first investment, purchasing my very first house. It was the best investment I ever made because I not only generated income for 7 years living in my house. My mortgage was only $1,500. I was bringing in $1,000 a month, so I was only paying $500 a month to live in this whole townhouse. And at the same time, 7 years later, I sold that property for $360,000, and I paid $195,000 for it. So I generated well over 6 figures from the sale, and I generated well over 6 figures over the 7-year period that I rented the property out. After I bought my first house, I kept saving, I kept stacking my money so that I can buy my next house. And the second house I purchased was a little old townhouse, not too far from where I lived. It was a 3-bedroom, 1.5-bath house, and I bought it for $80,000. And my goal was to actually buy it as a rental, but once I realized how much profit I could make from selling it fixed up, I decided to sell it. So I sold it for $180,000. I paid $80,000, and I put about $40,000 into it. So after I sold that property, I profited about $60,000 to $70,000, and I took half of that money to buy my next flip, and I took the other half to buy a rental property. So that was my introduction into real estate. Now I was able to do all of this over a 2-year period, but I did this with little to no guidance, and I learned a whole lot along the way. So that's why I'm creating this class. So I want to be able to share with you all not only the things that I've experienced, but also all the strategies that I've learned over the last 10 years in real estate. Now, before we dive deep into individual lessons, I want to go over some terminology first. Now, the first term is, what is real estate investing? Now, the Webster Dictionary is, real estate investing involves the purchase, management, and sale of real estate or leasing of real estate to earn a profit. So that's the Webster definition. My definition is simply this: using real estate to generate income, however possible. Using real estate to generate income, however possible. So there's different ways that you can invest in real estate. The more traditional ways are flipping houses, so buying a house at discount, fixing the house up, and then selling it for a profit. Also, rentals, buying a property as a rental property, and you'll be the landlord. You'll rent the property out to a renter and you'll collect the money every single month. Then you'll pay off your debts. And the difference, if there's a positive difference, is called cash flow. And that leads me to my second term, which is cash flow. So, cash flow is simply the income that you make after you pay off your bills and debts. So, if you have a rental property and you bring in $2,000 a month, and your mortgage is $1,000, and your bills are another $200, and your insurance is another $100, well, your total debt against the property is $1,000 plus 200 plus 100, which is $1,300, but you bring in $2,000. So the difference is $700. So your cash flow in that situation would be $700. Now, the next term is gross income. So gross income is the total income that you generated from the sale of that property. So if you decide to sell a property and you sold the property for $300,000, your gross income will be $300,000. And let's talk about net income. So your net income is basically your gross income minus your expenses. So let's say you buy a property for $100,000, and let's say you spend $50,000 fixing that property up, and you sell it for $300,000. Well, you made $300,000 on the sale, but you also paid $100,000 for the property, and you spent $50,000 fixing it up. So your net income would be $300,000 minus $50,000 minus $100,000, which would be $150,000. So your net income is your gross income minus your expenses. Your next term is down payment. So down payment is basically when you purchase a property and the bank is requiring you to put money down. So just like buying a car, if you buy a car for $30,000, but the dealership says you have to put $5,000 down, same thing with real estate. So typically when you buy your first property, you'll probably put anywhere from 3 to 5% down. Now let's talk about mortgage. Now a mortgage is just a loan that you got or received to purchase real estate. So when you go to the bank and say, I want to buy a $200,000 house, the bank says, great, we'll give you the money. When you close on the house, the bank will fund it, and now you have a mortgage of $200,000. Now the next term is rehab. Rehab is just simply the improvement or renovation of a property. So when you buy a house, we say we rehabbed it by saying we fixed the house up, and that's just the simple definition of rehab. And the next two terms are assets and liabilities. Assets is simple. Asset is anything that puts money into your pocket. That's an asset. If you generate income from it, it's an asset. And a liability is anything that takes money out of your pocket. So if it costs you money, then it's a liability. Now, most people, when they buy real estate, they think that they're buying an asset, and that's actually not true. So when you buy real estate, you have property taxes, you have a mortgage, you have insurance, and you have maintenance. All of these things cost money. And if you're not generating income from that property, which most people aren't, then it's a liability. It only becomes an asset when you sell it. And if you sell it for a profit. So if you buy it for $100,000, sell it for $300,000, then yes, you made a profit, but it doesn't become an asset until you have sold it. At that point, it put money in your pocket. So it's important that I explain that buying real estate does not necessarily mean that it's an asset. Now, how you turn real estate from a liability into an asset is the strategy. And that's what your strategy should always be. That's what I do in my life, and that's what I've always done for any of my real estate properties, is to generate income, whether it was a house I lived in, or whether it was a rental property, or whether it was a property that I managed, whatever it was. My goal was to always generate income so that the property is not a liability, but it's an asset. Now, I can sit here for hours talking about all the different terms in real estate, but I think that's enough to get you all started. So let's get into the first topic. And the first thing I want to do is position everybody's mindset. Now, understand this. Real estate is not a quick way to get rich. It really isn't. Real estate is a long-term strategy to build wealth. Now, you can make some good money along the way. And yes, you can make a lot of money quickly, but it's not easy to do. And it's not practical for people who are just getting into the business. So I want to correct you all's mindset so that you all understand that you look at real estate as a vehicle for a long-term success. I'm talking 5, 10 years plus. Now, real estate is one of the best investment vehicles to generate income and become wealthy. But there are some risks that you need to keep in mind. The first risk is market fluctuations. So understand the real estate market is like a roller coaster. It goes up and it goes down. It goes up and it goes down. Now, it doesn't drastically go up and down like cryptocurrency or like the stock market, but it does go up and it does go down. But keep in mind, over a 10-year sample, real estate is always going to be more expensive today than it was 10 years ago, 20 years ago, and 30 years ago. That's why people buy investment properties, and that's why people buy real estate for long-term hold, because they can buy for $100,000 today, and they know in 10 years it'll be worth $200,000. Now, the next risk is tenant issues. Now, man, I have had many rental properties, and I've had many tenant issues. Now, when it comes to tenant issues, the best thing you can do to get ahead of having any issues with your potential tenants in the future is to vet them properly. Make sure you go over all the checklist items when you're approving somebody to rent your property. Now, whether that's a background check, whether that's a credit check, an income check, an eviction check, you want to check every single thing. I mean, you want to look behind, under, behind every door, over top every door. I mean, you want everything but their blood, basically. I'm just kidding. But you want to make sure that you vet your tenants properly so that you can avoid as much tenant issues as possible. Now, you also want to make sure that you have an inspection done on your properties so that you know what's wrong with your properties, so that you know you won't have a lot of maintenance issues. And that leads me to my next topic, maintenance and repairs. So now, maintenance and repairs are inevitable. Things are always going to break, things are always going to go wrong. But you want to also make sure that your properties are in a good condition enough so that the maintenance issues are limited. So that's why I personally rent my properties out after I've done a renovation. So I buy a property 50 cents on the dollar, I'll do a complete rehab or renovation on the property, and I'll rent the property out at that point. So now that I know what was done to the property and that everything is working order, and I know who did the work, so if anything goes wrong, I call them to go back and fix it. Now, the next risk is one of the biggest ones, and that is liquidity problems. Now, liquidity is just your ability or access to cash. Now, real estate is a very expensive industry. I mean, if you saw the amount of checks that I cut in a year to different contractors or bills I've had to pay at Home Depot, I mean, it's ridiculous. I mean, construction, a loan, mortgage payments, all of those things are very expensive. So you have to understand that you don't want to over leverage yourself, or you don't want to go too fast and buy up a whole bunch of different properties too quickly, because guess what? For every property, you're going to have multiple bills. You're going to have multiple things that you have to pay. And I had to learn that lesson the hard way. So about 4 years into my career, I was feeling myself. I had flipped multiple properties, and I went out and bought 3 properties at one time. And I took on 3 other properties to manage Airbnb, short-term rentals. Not only did I over leverage my time, but I also over leveraged my money. I had properties that I couldn't continue to finish until I sold another property. And that's not what you want to do. Because what happens is when you have a property that's not selling, every day that it's not selling is costing you money. So if you're trying to finish the property, but you need to earn money in order to finish this project over here, well, you're losing money on this project over here until you've earned money over there. So you're building a house of cards, and that's what you don't want to do. So I had to learn that lesson the hard way. Always take your time, start off with one property at a time, and make sure that you could afford a property from the beginning all the way to the end, plus surprises, without going broke. So those are some of the risks. Now let's talk about the rewards. The first reward is cash flow. So if you remembered earlier, I did mention cash flow. Cash flow is just the income that you generate from a property minus your expenses. So whatever that positive number is your cash flow. So my very first rental property, I rented the property out for $1,550. My mortgage was $950, and I had $100 that I had to pay for home insurance. So my total expenses was $1,050. Rented the property out for $1,550, so I cash flowed $500 a month. And that was a really good rental property until it wasn't, and then I sold it. The next reward is called appreciation. So appreciation is the increase in value over time that you own the property. So if you bought the property for $100,000 and you sold it for $200,000, well, it appreciated $100,000 or 100%. The third benefit are tax benefits. So there are plenty of tax benefits offered to real estate investors like myself, or even homeowners in general. Now, one of the good tax advantages are mortgage interest. So when you pay a mortgage, the interest that you're paying on your mortgage is tax deductible. So you can deduct that from your taxes. Always talk to a CPA, because I'm not a CPA. And number 2, this is the biggest one. This is the biggest tax advantage that I know exists in real estate, which is selling your primary residence. So when you buy a home and you live in that home for 2 out of the last 3 years, guess what? You get to sell the property and accumulate $250,000 of profit untaxed. So the first $250,000 of profit, not of sales amount, but profit, is untaxed. And if you're married, that's $500,000. So that is a big hack that a lot of people don't know in real estate. If it's your primary home, and it has to be a primary home, I'm not talking about properties that you flipped. I'm talking about your primary residence. If you sell your primary residence, $250,000 or $500,000 if you're married is untaxed for the net profit. And the next reward is leverage. Now, most people don't have a ton of money ready just sitting to deploy in real estate. If you do, great. But if you don't, it's okay. Now, when I got started in real estate flipping, not only did I save up money, but I also leveraged other people's money to invest in real estate deals. So I called up my mama, my cousins, uncles, friends, family members, coworkers, not current coworkers. Don't do that. But I called up anybody I knew that was willing to invest in me and my strategy in real estate. And I raised $20,000 on my very first flip. Now I put $10,000 down myself. I raised another $20,000 and I used that as a down payment with a bank. So I also leveraged a bank to finance the construction and the rest of the purchase price. And I fixed the property up and I sold it. I sold the property for $190,000. I only paid $80,000. I raised $20,000 from outside investors. I paid them back interest on their money, about 30%, and I was able to keep in all the rest. So I netted around $60,000. Now understand, leveraging other people in real estate is a great strategy, but it also may be a necessity if you're just getting started. Look, let's be practical. I'm assuming you don't have $30,000, $40,000, or $50,000 just sitting in the bank ready to go out and buy real estate. And if you do, great. But leveraging other people's money may be one of the best things you can do when starting off real estate. But understand this, please make sure you know what you're doing, and please make sure you always have an exit strategy in case what you plan on doing doesn't go the way you planned. Now let's touch base on some of the other real estate strategies that you all can do. So we already talked about real estate flipping, buying and reselling at a higher price. We also discussed being a landlord in rental properties. But you also have another strategy called real estate wholesaling. Now, wholesaling is a very popular investment strategy for beginners. And honestly, I would advise anybody who's going to get into real estate to learn real estate wholesaling. It is a very good resource and a very good strategy to earn quick cash. So if you've ever watched some of those late night commercials where they say, hey, I'll buy your house cash. I'll buy your property in 7 days. You don't have to fix anything up. I'll pay all your moving expenses. I'll buy your property. Well, 9 times out of 10, those are wholesalers. Now, real estate wholesaling is this: getting a contract to purchase a property and then selling that contract to an investor like myself, someone who flips homes, for a profit. So I'll give you an example. Let's say I'm selling my property, and let's say you agree to buy the property, and you agree to buy the property for $100,000. So we sign a contract. I'm the seller, you're the buyer or wholesaler. You agree to buy the property for $100,000. We sign a contract. Now, before you actually purchase the property, you take that contract and go to someone else called an end buyer who is also interested in flipping this house. And you say, hey, look, I have this contract to purchase this home from Vernon for $100,000. I'm willing to sell it to you for $110,000. So if the end buyer is okay with that and agrees to buy the property, if it's a good deal for them, they'll buy it at $110,000. Well, you have a contract to purchase it from me for $100,000, and you also now have an assignment contract to the end buyer for $110,000. The money in the middle, which is $10,000, comes to you at closing. So the end buyer pays for the property, I get my $100,000, and you get $10,000. That's a quick way to make some money in real estate, and it's a very popular strategy. Now, another investment strategy is called shared space. Now, shared space is something that I love doing. Actually, this room I'm in right now is a podcast room in my house, and I rent this space out to podcasters that want to use a space for a podcast room. Well, anybody can rent a space of their home, design it so that it's appealable to content creators, and rent the space out by the hour to content creators or photographers or people that do videography. There's a big industry out there, and that industry is growing. So I think shared space over the next 10 years is going to blow up. Now, here's what I want you all to do between now and our next class. I want you to get in your car. Every time you leave your home, I want you to go a different route that you normally do. And I want you to start spotting real estate. I want you to make it an initiative to look at every piece of real estate that you drive past. And you're going to start identifying things that you didn't even notice before. You're going to start seeing houses that are under construction. You're going to start seeing vacant houses that you didn't even knew were there. You're going to see houses for sale. And I want you to write down these property addresses. Just write the addresses down. And I want you all to do this so that you can not only see the real estate activity going on in your market, but I also want you to do this so that you can start targeting homes and contact the homeowners to see if they're willing to sell the property. This is something that I did at the very beginning of my career. It allowed me to get an understanding of my real estate market. And that's what you want to do. You want to know exactly what houses sell for. You want to know the type of houses in your market. You want to know if everything is a townhouse or most homes are single family detached houses. That means there's no houses attached to it on either side. Are most houses colonials? Are they more traditional properties? How many houses are for sale in your market or in your neighborhood? If there's 10 houses for sale in your neighborhood, then something's going on in your neighborhood. If you see a bunch of properties under construction, then that means your property values are probably going up because people are investing in that area. If you see a bunch of vacant houses, well, guess what? Those are opportunities. Those are properties that you can reach out to the owner to see if they're willing to sell, and you could wholesale it to an investor like myself. So just understand your market. I want you to start driving around, even if you got to walk your neighborhood, just start looking at properties and seeing any activity and write the addresses down. And I'll tell you why in the next class. Now, I didn't want to give you all too much. This was just week 1. So hopefully you all did learn something. The goal of today's class was to teach you all the basic terminology in real estate, also give you all an introduction to real estate investment, share with you all different strategies that I use in my business so that you all can learn it and go and take that from there. Our next week's class is how to make money in real estate. So we're going to go deeper into the investment strategies that I introduced you to today. So don't forget your homework, and I'll see you all next week.